It's time for Watts on Wealth Radio with Barry Watts and your host, Ralph Hibbs.
The new year is getting closer and closer. We hope you're looking back fondly on 2024. What a year, huh? And also looking forward to 2025. As always, though, there's still a little more work to do before we toast in the new year. Welcome to this Sunday morning's Watts on Wealth. Hi, this is Ralph Hibbs. What housekeeping do you have left to do when it comes to your finances? We're going to ask the main retirement planner at Springfield's Wealthcare Corporation, Barry Watts, about that as we look ahead to turning the calendar page to 2025. I want to look back before we go ahead, Barry. 25 years since all that Y2K mess. Remember that, folks? And Barry, what are your memories of all that at the turn of the millennium?
Well, what it makes me think, Ralph, is about how old you're getting and how old I'm getting. You do realize you were in your 40s when that went down.
Yes,
And
mid
25 years ago, I was in my 30s when that went down. And here we are today. My goodness, 25 years ago. Here's an amazing thing. I've got financial advisors who are working for the Wealthcare Corporation who are doing a fantastic job, by the way, who were not even born when Y2K happened. So they reference Y2K kind of like I reference the Korean War, or like you might reference World War II.
Weren't there, didn't know about it, weren't there, just read about it. Yeah.
And, we thought that was going to be such a big deal, and everybody was scared the power grid's going to go down, the clocks are not going to work, and the water pumps are not going to pump and so forth, and we never missed a thing, everything. I don't think, to my knowledge, there was nothing that happened with Y2K that really mattered.
I don't believe so, no. People,
so pretty impressive.
People moving away to a different country, I believe you mentioned before, so it's crazy. But
that could have been a little bit of an overreaction.
Very definitely. I'd like to take a moment to dedicate our show to the amazing Dick Van Dyke, his marvelous TV and film career. Dick Van Dyke, born in West Plains, Missouri, and he hit the 99 mark, so he's definitely on the radar. As Barry says, you can live to be 100 and plan for that, and Dick Van Dyke is well on his way to that. So love Dick Van Dyke, and a native Missourian, and want to give him a little shout out here as we get going.
And a fun guy to watch. The only thing I've got against Dick Van Dyke whatsoever is he made a presidential endorsement here a few weeks ago that was a really bad one. But we're going to give him credit for being 99. We're going to just assume he had a little faulty thinking there, maybe.
Could be, but he's still a mover and a shaker, and we'd love for him to get to triple digits next year. I'm sure his financial planning has been well taken care of, but let's talk about everybody else around the Ozarks here. Let me get your number, Barry. If we haven't given that out in a while on our show, you can reach Barry Watts at the Wealthcare Corporation, 417 all around the Ozarks, 200-3500. Let's get back to now. Why do you think it's a good idea as we start our show? We're talking about taking stock at the end of the year, Barry. See where we are.
Well, isn't that what we do at this time of the year? Don't we kind of pause and take a deep breath and sort of look at things that we haven't looked at lately and kind of see where we're at, whether that's financially or in terms of what we accomplished this year compared to what we wanted to accomplish. So it's just, it's interesting. And when you stop and think about it, the degree to which it is human nature for us to just look back over the year and see where we are. And it helps you to look at your retirement strategy and your investments, but your healthcare plan as well, and your legacy. And I've been doing all those things personally, but I'm also helping clients do all of those things. There are a lot of moving parts, so it's just a good time to sit down and reassess and put in a little bit of effort into the key priority areas. And the other part of that, Ralph, is that the new year, when it gets here, which is only 10 days away or so, it's going to create some new opportunities, planning for next year's taxes among those. And so we're excited about that. If this year's work is anything similar to what next year's work could be, next year could be a really profitable year in terms of tax saving strategies for some folks. And so I'm excited about the next year, but we've had a great 2024. I am deeply, richly blessed and fortunate. Ralph, now that the term blessed has become so popular, you do know it's become popular, don't you?
Oh, I can tell it. Yeah.
I think it's because of Chick-fil-A.
Oh, yeah.
Because, Chick-fil-A trained all their people to say, have a blessed day.
Which is closed today. It closed every Sunday.
Well, yeah, that is true. So don't go to Chick-fil-A today. Chick-fil-A has a good product. I'm not as crazy about it as everybody else seems to be, but it's a good product. But they trained everybody to say, well, have a blessed day. And so it's become trendy. Everybody's have a blessed day, have a blessed day, have a blessed day. And so you see a lot of people who are cursing, who'll turn right around and say, have a blessed day. You know, the Bible speaks about that. Says you can't communicate cursing and blessing from the same mouth.
All right.
But anyway, what I was saying was, what a great year 2024 has been. What a great year I'm looking forward to in 2025.
Barry, I would add to what you just said. I like when the athletes at the end of the game, well, praise God, you know, the blessing of God, and we loved our team effort and all. So they throw him in there at the end of a football game. I don't know if he's watching up there, but get back, if he watches a lot of NFL or whatever. I'd like to elaborate on what you just said in your answer. If we're looking to evaluate where we are at the end of 2024, specifically, where should we be starting on our reset?
Well, there are lots of ways to do that. I mean, it just depends on what's important to you. Now, Ralph, I'm in the money business. So the most natural thing for me to talk about is evaluating where you're at with your money in your portfolio. And so this is a good time to kind of catch up and become familiar with what's in your investments and how they've been performing this year. For example, the S&P 500 is up somewhere in the neighborhood of 27% this year. So for every dollar you had invested, you ought to have $1.27 at the end of the year if you were keeping track with the S&P 500. Now, the question is, should you be comparing yourself to the S&P 500? And I'm actually going to tell you, no, that's not what most people should do. They don't give out any extra awards for meeting or beating the S&P 500. It's just a measurement that kind of tells you how the year went in investing, and it allows you to kind of know where you're at. Now, many of our clients, Ralph, are invested far more conservatively than the S&P 500. You know, we like to speak about risk on a scale of 1 to 100. The S&P 500 sets at about a 74 in terms of risk. Think about driving down the road. How fast do you drive 1 to 100? And at 1, if you have a wreck, nobody even knows it, nothing happened. And at 100, if you have a wreck, it kills everybody who's involved. Well, so the S&P 500 is about a 74 on that particular speed scale. And I would say for most retirees, that's probably too fast. And some of them say, well, I drive 74 miles an hour. Why wouldn't my investments go 74? And I think the answer to that question is because they don't have to. They absolutely don't have to in order to achieve most people's objective. I don't know what our listeners' particular objective is, but I will say this, that if you're going 74 miles an hour with the S&P 500, you have to be willing to tolerate what comes with that. And that can be losses in excess of 50% in down markets. Ralph, you do know that the stock market can go down.
Yeah, it's already been to 45,000 this year, and the NASDAQ's been doing well.
Well, yes, and that's the whole point is in times that are so good, everybody loses track in the fact that it can go down. So nobody's thinking about it can go down. They're just all enjoying the heady days we have. And then one day when it does go down, everybody starts shrieking, screaming, and fainting. And so we try to help people think through that. My point is that a lot of people, we drive them in portfolios of 45, 50 miles an hour, something like that. And they have excess money at that particular speed. So I don't think you ought to try to keep up with the S&P 500. It is a good time, though, to look at how diversified you are. And back to the topic of risk, how much risk you may be taking. So think about this. This is a good time at the end of the year, perhaps, to rebalance yourself so you have more of your principal protected. Now, let's say that you have a portfolio that is 50% protected principal and 50% subject to the market risk. Well, the 50% of your portfolio that's subject to market risk this year probably ought to be up somewhere in the neighborhood of 28%. So if you had $1 million and $500,000 of that was in subject to risk invested in the S&P 500, it ought to be up somewhere in the neighborhood of $135,000 this year on that half of the $1 million. And so if you want to have a 50-50 risk protected and risk profile, well, then you've got about $70,000 that needs to be moved out of that risk position back over to the protected principal position. Right now, Ralph, when I bring that up, people are like, why would I want to do that? You know, it's doing great. Why would I want to take money at 27% and put it over at 6%? And the answer is because somewhere out there is a day coming where that really positive big number is going to turn really negative in a big number, and you don't want your principal to go down with it. And so balancing this is something we do every time we meet with our clients. And it's a good thing to be talking about it right here at the end of the year, because this is a good time to take your December 31 statement from last year and compare it to your December 31 statement of this year. You don't have that yet. Compare it to where your account balance is this year, and just look at the difference. Maybe some of that money needs to be redirected to protected principal before we get into a negative market position at some unknown point in the future.
It is truly a balancing act on the high wire, and Barry can help you make it all the way across there. 417 200 3500 200 3500 for the Wealth Care Corporation. Well, Barry, I'm sure I had mine. You probably had yours. We have our physicals. We check with the doctor. How am I at the end of this year? And looking ahead to next year on healthcare. And what about the cost of paying for that if we're not so well?
Well, this is a good time to look at healthcare, and because it's a huge expense for most people, particularly for retirees. Now, of course, Medicare open enrollment, Ralph, just ended back on December the 7th. So
Right.
if you didn't make a change and you needed to make a change, that ship has sailed. Hopefully, though, you got an automatic review of either your Medicare supplement or your Medicare Advantage if you're a retired person, and hopefully you've got one of those in place. So I'm trusting that your advisor, your financial advisor, brought that up and said it's time to do your Medicare review, because we do that automatically every year for every client that we're helping with their Medicare. It's critically important. And one of the areas where we were able to make some significant changes this year were in regard to the prescription drug cost Plan D. A lot of people made changes in Plan D because the Inflation Reduction Act actually changed some of the rules to Medicare, how much you pay for your pharmaceuticals. And so there was an opportunity for many people to move to more favorable plans. Ralph, I'm not the expert on that, quite frankly, but in our office, we do have an expert. His name is Matt Dean, and we call him Medicare Matt around our place, and he helps all our clients with that sort of stuff. So when you become a client of the Wealth Care Corporation and it's time to talk about that particular topic, Matt comes into the room, and he's the specialist on those things. But these are the things that can make a big difference, thousands of dollars saved in your expenditures over the next year. And so it's a part of what you ought to be looking at and thinking about for the future. Always pay attention to this, and it really ought to happen there in the last quarter of the year before we get to this point.
That's right, Barry. And we're going to take a break on the Wealth Care Corporation show. Barry Watts and Watts on Wealth. This is Ralph Hipp along with Barry, and we'll get to the topic of taxes in a moment. Don't go far. We'll be back right after this.
Are questions about your financial future, such as, have I saved enough, or will my money last, keeping you up at night? Reach out to Barry Watts by texting VISIT to 417-200-3500. Again, that's text the word VISIT to 417-200-3500 to schedule your consultation today. Do you think you'll pay lower taxes in retirement? Really? Many people go into retirement assuming that, but end up paying as much, if not more, in taxes than when they were working. How taxes can affect your retirement is one of the chapters in Watts on Wealth, the latest book written by local tax strategist and retirement designer Barry Watts of the Wealth Care Corporation. Barry takes you through the many tax considerations you should make before you retire. To get your free copy of Watts on Wealth, the book, call 417-200-3500 or go to wattswealth.com. The book is full of actionable retirement tips and strategies Barry has gathered from his more than 30-year career in helping families just like yours retire successfully. Get your free copy of Watts on Wealth, the book, now by calling 417-200-3500 or go to wattswealth.com. Advisory services provided through Wealthcare Asset Management, LLC. Life is full of uncertainties, but your retirement plan should not be one of them. Don't let market fluctuations dictate your future. Contact Barry Watts to secure your retirement today at 417-200-3500. Again, that's 417-200-3500.
Welcome back into Watts on Wealth. This is Ralph Hipp along with Barry Watts this Sunday. Glad to have you along. And We're looking back at the year gone by, looking ahead to 2025 on our holiday show today. Barry, let's get into taxes, and it's a huge impact, and we may see some changes or may see our tax world that we have continue beyond 1 year for the next 5 years. And what do we need to be doing in terms of looking at where we are in our tax situation, not only the tax preparation coming up in April, but tax planning with you and the tax strategy of it, tax efficient strategy?
Well, unfortunately, Ralph, when you say the word taxes and you need to get ready, what people automatically think is, oh, yeah, it's going to be time to file my taxes. So I need to gather my stuff and turn it into my tax return preparer. And that is not the point that I'm trying to make. This is a time to actually double down on and say, doggone it, I'm going to do some tax strategy work, not tax preparation work. Because there are some things you can do to reduce your tax liability significantly. Maybe in a few minutes we'll have a chance, and I might tell you a story about a client of ours who came to us last year owing over $2 million in taxes. And at the end of the year, they paid $200,000 in taxes. So we reduced their tax bill by 90%. Now, don't misunderstand. I can't do that for everyone. But this particular person obviously was a business owner, and so there were some opportunities to help them. Indeed, we reduced them from $2 million in tax to $200,000 in tax, a 90% reduction because we did strategic planning. So this is a good time to be thinking about, hey, is it possible? What can be done? And I'm going to guess, Ralph, for over half the people who listen, there are some minor adjustments that can be made that will make differences that might be a few $1,000s. There aren't going to be very many people listening who have $1 million differences, but if you're one of them and you're paying six figures or more in taxes, that's an area where we might be able to help you. One of the ways that we help is we try to optimize the amount of after-tax income, because we want to be sure that as much of your income as possible comes to you in a tax-free sort of way. You do realize, don't you, Ralph, that there are two types of taxes: those you have to pay no matter what, and those that you don't have to pay, but that many people pay voluntarily. And people say, well, now that's silly. There are no voluntary taxes. Folks, I do this for a living. If those people hadn't come to see us, they would have paid $1.8 million in voluntary taxes.
Oh, boy.
So our goal when we sit down and review this with people is to help them categorize their taxes in two ways. What are the ones that you do have to pay and we can't get away from? What are the ones that you don't have to pay if you'll take a certain set of steps? And let's eliminate those if we can. Now, it's probably too late at this point to be able to do Roth conversions. I love Roth conversions, and I'd recommend them. In fact, I did a Roth conversion about 10 days ago. It was the last one we did, and there's some question about whether it'll actually get processed by the end of the year. The problem is the processing. Deadline is 12/31. But this stuff gets stacked up on the desks at all the custodians, and those people all want to go on Christmas break. And when 5 o'clock comes, they walk away from their desk in the stack. And so sometimes things don't get done. It's why we tell people that the deadline is Thanksgiving. So we have plenty of time to get that stuff processed. It's not too late to use tax credits. I, for example, know of some tax credits where you can pay your tax for 60 cents on the dollar. Now, you've got to be paying six figures in taxes in order for those tax credits to work for you. But to be able to pay taxes for 60 cents on the dollar is a really good idea. I also know about some charitable gifting strategies where for every dollar you'll put in, you'll get credit for $5 of charitable gift. That's pretty exciting and interesting. So there are just some things you can do that you ought to know about. And probably what people are saying is, well, either this guy's crazy or my CPA didn't tell me. And the answer, folks, in most cases, 99% of them is no, your tax preparer, CPA, whoever that person is, didn't tell you, because what they're really trained to do is fill out government forms and take last year's numbers and put them onto those forms. They're not trained to be forward thinking about how can we reduce those numbers. And I'll tell you, when you pay the kind of taxes that I do, you're really interested in how can we reduce those numbers. And of course, our clients, many of them pay those kinds of taxes. And so we're interested in reducing that as much as possible for them.
Barry, I would venture to say December 31st is just as important, if not more important, than April 15th on our tax preparation. Here come our forms, get the forms together, and what are our accounts doing, and all that sort of thing, and get ready for the CPA call that number for your CPA. But also on the tax planning, the tax efficient strategies, give Barry Watts a call at the Wealth Care Corporation. It's 417 200 3500 for that part of it. Barry, I wanted to also ask you more about charitable giving and also RMDs, those required minimum distributions, if we're 73 in most cases, and specifically the circumstances about those two things.
Well, if you turn 73 this year, you do have to begin making required minimum distributions, and you have until December 31st to get that done. Now, hopefully, again, your financial advisor brought that to your attention and said, hey, pay attention to this. It's got to be taken care of. We have a habit of reaching out to all of our clients to make sure they do their required minimum distributions from their IRA accounts.
Yeah.
Charitable giving, though, is another thing. For example, a lot of people are giving to charities, and what they do is, let's say you want to give $10,000 to a charity. And I know people give different amounts. I'm just using a number. Don't get stuck on the number. Just get stuck on the concept. Well, if you want to give $10,000 to a charity and you're in the 30% tax bracket, what has to happen is you have to take $13,000 out of your investments, pay $3,000 in taxes, and now you got $10,000 left to give to charity. But did you know that if you just wanted to give $10,000 to charity, you could give it directly from your IRA and there would be no tax bill due if you're over age 70 and a half. So qualified charitable distributions is what that's called. And we help a lot of clients learn how to give more efficiently so that Washington is never paid and it actually takes less money to give the gift because there's no tax to be paid. So all the money is going directly to the charity. Now, the maximum amount in qualified charitable distributions that you can give is $105,000. Your pastor called this morning before he went into services, and he told me that they are accepting donations from your IRA accounts in the amount of $105,000 for qualified charitable distributions. And he wanted you to call WealthCare and get signed up this week. So obviously, that's a blessing to charities and anybody who's running.
Blessed day.
That would be a blessed day. That's exactly right.
That's what we're talking about.
And here's the good thing, Ralph. By the way, those charitable distributions, they satisfy your required minimum distribution.
They do.
So you don't have to make an RMD if you're making a QCD, a qualified charitable distribution. So just another tip there on how things work.
Well, we're talking about looking at this year gone by. Where are you right now? Where will you be going into 2025? And are you ready? The income streams, insurance is another issue. Tax efficient strategies we've talked about, the cost of healthcare. How's your investment portfolio? How's your legacy planning? All these pieces go into a retirement strategy. And if you've been working with somebody else in all these areas, well, it's time to start talking with a retirement planner. And Barry, who called you this week and wanting some advice from you?
Well, I did have a fella call me this week, just interesting character. He happens to hold a PhD. He is at the university teaching. He's also a farmer, and he wanted to talk about a lot of things, and he's loaded with all of these questions. His mother just died recently, and he just inherited her farm. He's an only child, and he had to go through the whole process of getting the farm to him and then selling the farm to somebody else. And in the midst of it, the question he asked me when he called is, he said, Barry, there's this guy on the internet giving Social Security advice, and he says everybody should take Social Security at age 62. I just want to know what you think about that. And what I said was, I don't really care, because are you about to retire? Well, no, I'm going to keep working for another 4 or 5 years, drawing a decent check from the university. Then guess what? Every dollar you get in your Social Security check is going to be taken back away from you because you make six figures as a university professor. And anything over about $23,000, and then they start taking back $1 for every two. So if he had activated his Social Security at 62, then it wouldn't have worked for him. He would have just locked himself into a perpetually lower 62 Social Security check, but he wouldn't have benefited from it all these years because it would have been taxed away from him. Well, he didn't know that. And the guy on the radio or on the TV or on the YouTube who was giving out that kind of advice wasn't thinking about my friend's personal situation. And so I just tried to help him understand how to think about that. And so we then talked about the company that was managing his investments. He said, he's not our client. He's got his money somewhere else at a different firm, one that's not very prevalent in this part of the country. And he said, tell me what you think about them. Are they good? Do they know what they're doing? And since he's a farmer, the question I asked him was this. I said, tell me this, is the feed at MFA any good? He got it immediately. I could tell by the chuckle in his voice, because the answer is you can buy some of the best feed in the world at MFA, and you can get a bag of some of the worst feed in the world too. It just depends on how that feed was manufactured and the recipe that was used and the precision of the people who were putting the ingredients in. So what I did is I backed up and I said, look, I called him by name and I said, the people you're talking about are managing your money. So they're hoping this year maybe they had that 27% return that matched the S&P 500, but they're not planning your retirement. If they were planning your retirement, they'd be talking about income. Have they talked about that to you? No, we haven't talked about that. Well, they'd be talking to you about how to reduce your taxes. Have they talked about that? No, I don't get any of the advice from that. What about protected principal? No. Well, what about long-term care, estate planning? He said, well, I do have a trust. Congratulations. That's really good. And we then pivoted to talk about his mother who had recently died. And one of the things that came out of that is his mother, he was the only child. His mother had put her farm into a trust so she could avoid probate. Now, what did that cost? And how hard was that? Because there were extra things she had to do paperwork he had to sign in processing the trust. Sure, right. Do you know, Mama could have just put his name on the farm as a beneficiary using a beneficiary deed here in the state of Missouri, and that farm would have gone directly to him upon Mama's death. The trust wasn't necessary. He said, well, then why did they recommend one? And that got me into another topic that I won't get into this morning because we might have some lawyer friends listening and I don't want to talk bad about it. All right. But the point is, here's the deal, Ralph. The investment company that he was working with, they're just managing his money for investment. And they weren't getting for him what he needed. At the Wealth Care Corporation, we talk about all of those things. For the same fee he's paying his investment company, we're going to talk about income and taxes and protected principal and long-term care and estate planning. And oh, by the way, we do have a CPA in our office who does tax returns for our clients if they want it done. So all the information is right there under one roof. It's just so much easier. It's streamlined. One-stop shopping. And that's very effective for us. So that's the approach we use. We call it holistic planning. And I would suggest that that's what you need, and that's what we provide at the Wealth Care Corporation.
Well, that is so great. And talk about shopping under one roof. How would you like that on your financial planning? It's great. All at the Wealth Care Corporation right here in Springfield. It's all local. 417-200-3500. And Barry, I was noticing the one thing that all those things that they did not talk about with him, the one thing he had on his checklist, the trust, he didn't even need. So we got to get it.
Yeah, exactly.
Yeah, we've got to get it all together, folks. And that's what we're talking about on the show today. Time for a little news break. This is Ralph Hipp along with J. Barry Watts of the Wealth Care Corporation. Stick around for the next half of Watts on Wealth. We'll take this pause and be right back after this.
Worried about whether your savings will see you through retirement? If you're asking yourself questions like, have I saved enough? Or will my retirement last? It's time to talk with Barry Watts. Simply text VISIT to 417-200-3500. That's text VISIT to 417-200-3500 and arrange your visit today. Life is full of uncertainties, but your retirement plan should not be one of them. Don't let market fluctuations dictate your future. Contact Barry Watts to secure your retirement today at 417-200-3500. Again, that's 417-200-3500.
We're back with more of Watts on Wealth this Sunday, and delighted to have you along on this blessed day. Barry, right? Another blessed day in Springfield.
Yeah, it's a blessed day. Every day that you're above the turf is a blessed day. Doesn't feel like it. Sometimes you have to be reminded, but it is. It's a good day to be alive.
It can be a struggle sometimes. We know that, folks, but financially and speaking about your retirement planning, Barry can make it a lot easier for you. Did you know, my friends, the Internal Revenue Service sends out more than 8 billion pages of forms and instructions every year on how to get your taxes filed. This is a busy time for many of us. Barry and I are talking about what do we do before New Year's Eve, getting ready for April 15th. There's so much to do, easy to put it off till the last minute. Barry, I'm sure that time between January 1 and April 15th is when most Americans do have taxes on their radar. That's a mistake, though, which we'll get more into, but taxes are a topic we have to talk about in retirement. And is there anything we have to know when getting ready to file our taxes for 2025 or covering that 2024 tax year?
I don't know, Ralph. I can't get to that. I'm still stuck on 8 billion pages of instruction. Really? 8
Really,
billion
If
pages?
you if you stacked it up, Barry, it's more than our height. It's more than 6 feet tall. Yeah,
You do know, I don't know how tall 8 billion pages would be, but it'd be a lot taller than you and
my
me both put together. Do you know, Ralph, that the new commissioner of the IRS, soon to take his seat as Trump has appointed him, he's got to go through Senate confirmation, is Springfield's own Billy Long.
Yeah,
And Billy's going to be the new IRS commissioner. One of the first things I may talk to him about, hey, Billy, can we cut those 8 billion pages back to 8 million pages?
cut it back.
Would that be possible?
I'd sent you his picture. Barry, you know Billy, right? And you said, yeah, you'd met him and had talked to him several times.
Oh, of course. Yes.
We were chatting
In fact,
about
I
that.
was texting back and forth with him last week just
Oh,
after
very good.
Trump
Very
had nominated him. And so maybe we'll have a chance to get him on the show or one of our podcasts or something like that. I don't
that'd
know.
be very
He of
cool.
course, now he's gotten tremendously busy all of a sudden. But there are some things that you need to think about if you're preparing your 25 taxes, your taxes to be paid in 25 for 24, actually. First thing I would mention to you is you can still make IRA contributions up until April 15th. So I would get that done if you by chance haven't. Business owners can still establish cash balance plans until September 15th. You can buy the tax credits I was talking about, where you pay taxes for 60 cents on the dollar, even after January the 1st. So there are still some things you do. Now, 1231 closes a lot of doors. A few doors remain open, closes a lot of doors. And frankly, our calendar is totally blocked up between now and the end of the year at this point. So we couldn't visit with any people right away and get any problems solved for this year. But the benefits that extend past the first of the year, we can still appropriate those for people. So you should be thinking about those things. It'll help you to deal with the tax bill that's coming.
What do you and Billy Long and I need to know about hidden taxes, Barry?
Well, Ralph, there are any number of things that we could consider a hidden tax. For example, many people pay more than the minimum for Medicare. It's called IRMA, and it's IRMMA, I believe is the way that spells itself out. And IRMA is the additional money you pay for Medicare because you make too much money. And that's just another form of hidden tax. You know, people look at Social Security and they think, well, of course you pay a tax on your Social Security. That's inevitable. But it's actually not inevitable to have to do that if you have planned properly. So remember, there are two kinds of taxes. There are taxes that you have to pay and you can't get out of. And there are taxes that you pay only if you volunteer to pay those taxes. And the point is, if you have any voluntary taxes in your life, wouldn't it be a good time to get rid of those? Yes. So let's step up and do that. And you're going to have to work with somebody who's an expert. Now, I'd ask you this question. When you talk with your financial advisor about taxes, what do they say? I almost know what the answer is almost every time, which is they don't say anything because they say, well, we're not tax people. You have to ask your tax man. We can't do it. We don't know. Ralph, I used to say that. I got so tired of saying that and people looking disappointed and downcast. I actually went back to school. I went and trained under the IRS, got credentialed by the IRS to become an expert in taxes. And I actually have credentials that exceed what the CPAs have in terms of tax knowledge. And it allows me to speak into this issue in quite a helpful way for many of our clients. And it's been a great difference maker at the WealthCare Corporations. It's one of the differentiators of our firm. What we offer that other people don't is taxes are at the very core of our planning process. And I think they need to be at the core of your retirement planning process as well.
Many, many, many retirement planning companies do not do tax preparation. They leave that to the CPA you've worked with for years. But you do both of those things, Barry. Let me get the number again for the preparation and especially the planning, 417-200-3500. So most of us focus on just getting our taxes done right now by April 15th. And explain to us, you do both things under one roof. And what are some of the basic concepts, the differences between getting our taxes prepared and getting our taxes planned, Barry?
Well, almost nobody has their taxes planned. They think they don't even know there's a plan that you can plan your taxes. They think you just have to respond to the fact that taxes are due and pay whatever they are. It simply isn't true. I want you to think about it this way. Pretend you're driving a car down the road. You can either look out the front windshield and see the things that are coming, or you can look in the rear view mirror and see the things that happen. Well, what tax preparers do is they look in the rearview mirror and they say, what happened last year? All right, let's bring all those numbers onto the government forms and put them down. And at the bottom of the form, it'll tell us how much tax we have to pay based on what happened last year. That's a tax preparer. What a tax strategist does is looks out the front windshield and says, what's coming up down there? What kind of tax is that going to incur rather? Is there any way we could steer left or steer right? Remember, we're looking out the front windshield. And could we steer left or right and avoid a tax pothole? So tax strategists plan that so the numbers will be different at the end of the year that the tax preparer receives. That's the great difference. And I just had a CPA in my office this week who said, Barry, I want to watch how you're doing this because I want to learn how you think about this idea of tax strategy. Now, he's a certified public accountant and has been one for over 40 years. But I'm having to teach him how to think strategically about taxes because nobody else taught him. And he recognizes that now. And that's why he's coming to see us.
Well, we're talking about taxes and looking ahead to 2025, not only the tax preparation for April 15th, but the tax planning way beyond that. And Barry, we know, and I know, and I've been retired for a little over 2 years now. We know we get our paycheck and some of that is withheld, and we get our W-2 and we put that in the stack and just hand it over to the CPA. All of us get that. But in retirement, how does all that change the way that we're taxed?
Well, Ralph, I think the big thing is about control, and you actually have some control over how you're taxed prior to retirement. When I say you have control, it means that there are options you can choose in terms of timing, when you take the income. Options you can choose in terms of what your tax bracket is, because we can make adjustments that will adjust the tax bracket. Once you turn retirement age, though, you do retire and you reach age 73, where the required minimum distributions start for anybody born before 1960, you lose control. You lose control of the amount of income that you must receive. You lose control of the tax rate at which you pay that income, and you lose control of the timing of when you take that income. Now, let me walk through that with you. When your RMD age, they say 73, time to take the income. You say, well, I don't need it this year. I don't want it this year. Tough luck. It's time to take the income. You have to do it. You've lost control of the timing. And so then they say, and here's the amount that you have to take, your required minimum distribution. You say, well, I don't need that much. And they say, it doesn't matter. This is the amount that you must take. So you've lost control of the amount that you must take. And then they say, and here's the amount of tax you must pay. And you say, well, I don't want to pay that much tax. I'd like to do some tax strategy and make it different. And they say, tough luck. You can't do that. You got to pay at your tax rate. And so you've lost the opportunity to adjust and change those. What we're trying to do with people who are 50 to 70, essentially, or 55 to 73 age, we're trying to help them make some adjustments now while they have control, so that by the time they get to where they lose control at age 73, they're living on a fully tax-free income, and none of that matters. That's what we help people with at the Wealth Care Corporation.
To get the control back. Barry, we're about a month away from Donald Trump coming back, Trump 2.0 in the White House. He was the initiator of the Tax Cuts and Jobs Act of 2017, our biggest overhaul of tax policy in about 30 years. And it was set to expire January 1 of 2026. There may be some changes coming. So let's talk about wrapping up taxes in 2025. This is the big topic here. What are our existing opportunities to save on taxes in 2025? And we don't know what kind of a tax world we're going to have. Help us see clearly on that.
Well, taxes are set to go up January 1, 2026. That's what the law says, and we assume that's what's going to happen. We can look at Trump and say, well, he'll probably extend those Trump tax cuts now that he's back in office. He can't do that, by the way, without the Congress. But the Republicans have both houses of Congress. So the chances of that occurring are probably great, but they haven't occurred yet. So We don't deal with what might occur. We deal with what is. And what is taxes are going to go up on January 126. Now, let's just pretend for a moment that taxes were not going up January 126 because the tax cuts were going to be extended. The Trump tax cuts would be extended further. And I think there's a pretty good chance that that could occur. Well, if that does occur, it really doesn't change the story. It just gives us more room to get our house in order before those tax increases come. And they are going to come no matter what Eric Burleson and the Republicans tell you. Tax increases are going to come. That wasn't a shot at my buddy Eric or Republicans. The fact is that the point I'm trying to make is that ultimately taxes are going to have to go higher, not because of the Republicans, not because of the Democrats, not because of the debt. Well, yeah, it is because of the debt, but it's really because of the math that's associated with all that. And there is math that is irrefutable and undeniable that's going to cause tax rates to go up in the future. I promise you, when you die, taxes will be higher than they are today. And the good thing is, when you die, you won't know it. So if I'm wrong, you won't come back and attack me then. But no, the point, Ralph, I'm trying to make is that taxes have to go up in the future. And if we get an extension of these Trump tax cuts, that'd be a great thing. I'm excited about that because it just gives us more room, more time to get our money moved into tax-free positions before tax rates eventually go up. And so if you're working with an advisor who doesn't do taxes, I shouldn't have said do taxes because everybody thinks do means file tax returns. That's not it. If you're working with an advisor who doesn't do tax strategy, who won't sit down and look at your tax return and plan on how things could be changed to make it different, you need a new advisor. You need to upgrade. It's time for you to have an advisor upgrade to someone who specializes in tax strategy, and we train our advisors in the Wealth Care Corporation to be tax strategy experts. That is our specialty. It's the unique ability we bring to the marketplace. You know, anybody can recommend an investment to you, and you can kind of get the same investments at all places. Now, there's a lot to be said for how you manage those investments and when you go in and out and the things you do. But the big thing that's unique that you can't get in most places is tax strategy, and that's what the Wealth Care Corporation provides.
We're going to have Barry put on his boots. I don't know if it's the little kicking boots he wears on the farm in Rogersville, but his Santa boots and advice on some particular scenarios and whether these people are on the naughty or nice list for the holidays when Watts on Wealth continues right after this holiday break.
The pace of inflation may change, but it never disappears. How might it affect your retirement nest egg? Get the answers by calling Barry Watts at 417-200-3500. Once more, that's 417-200-3500. Do you think you'll pay lower taxes in retirement? Really? Many people go into retirement assuming that, but end up paying as much, if not more, in taxes than when they were working. How taxes can affect your retirement is one of the chapters in Watts on Wealth, the latest book written by local tax strategist and retirement designer Barry Watts of the Wealth Care Corporation. Barry takes you through the many tax considerations you should make before you retire. To get your free copy of Watts on Wealth, the book, call 417-200-3500 or go to wattswealth.com. The book is full of actionable retirement tips and strategies Barry has gathered from his more than 30-year career in helping families just like yours retire successfully. Get your free copy of Watts on Wealth, the book, now by calling 417-200-3500 or go to wattswealth.com. Advisory services provided through WealthCare Asset Management, LLC. If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Barry Watts. Text VISIT to 417-200-3500. Again, that's text VISIT to 417-200-3500 now to set up your appointment.
Watts on Wealth is the name of the show, also the name of Barry's book and his website. You just remember Watts on Wealth and those YouTube videos on the website as well. Anything you want to mention about the book or the YouTube videos, Barry?
Well, yes, I think we should, Ralph. Tell people that they can get a copy of the book, Watts on Wealth, where we talk about many of the concepts that we teach about here on the radio show. Exactly. They can have a copy of the book simply by texting the word book, B-O-O-K. and text it to 417 200 3500. That's 417 200 3500. If you just text the word book, BOOK, then our team will actually mail an autographed copy of the book out to you, and you can have it in your hands. In fact, my friend who called yesterday, the farmer PhD guy I was telling you about, he had read a copy of the book. And that's what got him started. And I didn't even know he had a copy. So we'd love for people to have a copy of the book. We distribute it to them free with no charge. We'll mail it out to you. And we'd love for everyone to have a copy of that. You can go to our YouTube channel. If you'll go to YouTube and just look for Watts on Wealth, Watts, WATTS on Wealth. It'll pop up. There's probably 50 or so YouTube videos on there. That there's even video that has Ralph Hibb. You can see Ralph Hibb's face. Because he also hosts he hosts our TV show, and the TV show is on KY3 on Sunday mornings, and it's on KSPR, and it's on KRBK, and I don't know if it's anywhere else or not right off the top of my head, but the show's out there. You can watch it a lot of different times.
We're on Color 10 as well. Just check.
Yes, we are on KOLR. I'd forgotten about that. That's correct.
Right. So 2025 will be on all the channels, and check out the YouTube videos and check the TV show. I think the TV show is just as awesome as our radio show. Santa has a book that he writes in the Naughty or Nice book. And when we were growing up, we knew about the Naughty or Nice list, which he's probably texting instead of writing these days. And your behavior got better as Christmas rolled around. We're going to have Barry Watts put his feet in his boots here. I've got a guy, Sam, here in our first retirement scenario, Barry. We want to run this by you. Sam is 60 and he's thinking about retiring early in a couple of years. He loves the idea of having more free time, go to the lake and fish, whatever. He's only managed to save a small amount for retirement. His wife is Allison. She's worried about not having enough income from their Social Security benefits. Sam reassures her, it's not going to be a problem. So what do you think, Barry, as retirement Santa? Is Sam's decision falling under the naughty or nice answer in our retirement planning?
Sam, dude, you got to upgrade your thinking because you're on the naughty list right now. Think about Allison. When Allison tells you that she's concerned, that's a showstopper right there. You need to listen to Allison. One of the things that we men are bad about is neglecting our wives and not listening to our wife and being appropriately responsive to them when they express concerns. You need to deal with that concern. And when she says there's not enough money, well, you need to listen to her. And maybe there is enough, maybe there isn't enough based on what you've said. I'm guessing there's not. But one way to figure that out is to do a retirement income plan. That's what we provide for folks at the Wealthcare Corporation. We don't even charge for that particular piece of the work. And the retirement income plan will show you whether or not there's enough money. It'll show you, Sam, whether you or Allison are correct. And the other thing I'm concerned about, Sam, is if you retire right now at age 60, well, you can't even take Social Security until you're 62. But if you take your Social Security at 62, you have consigned your family to the lowest possible amount of Social Security until both of you die. And I'm going to guess, Sam, that you will die first and that Allison will outlive you by 7, 8, 10, maybe 20 years. And when you die, Allison will probably get your Social Security number and it's going to be a lower number. So, Sam, you're not being very nice to Allison. It's time you really upgrade things. You need to think a little more deeply or you're going to remain on Barry's naughty list.
I read an article, and I would just have you search, friends, for the article of leaving benefits on the table. When you retire at 62 and start pulling it out, you're leaving money on the table that you can't afford to leave on there anymore. And search those articles and read about that, too. Here's another scenario for you, Barry. This is Bob and Alice, both recently retired, and they're thinking about leaving their busy lives behind in New York City and moving to North Carolina. They think the move will give them a chance to enjoy a lower cost of living, a better community of fellow retirees. Do you think that Bob and Alice, are they naughty or nice when it comes to moving when they decide to retire?
Well, I'd have to know more to know for sure. I certainly like the idea of North Carolina. I've been in North Carolina a lot in the past 2 months. Just coincidentally. And North Carolina is a beautiful state. On the eastern edge, you've got all the ocean. And on the western edge in the mountains there, oh my goodness, it is flat out gorgeous. There's some lovely country and some lovely people there. So So I'm going to give you credit, Bob, for the idea of moving to North Carolina. I think that could be a good thing, depending on the circumstances with your family. One of the things that is going to help Bob in this particular case is I think you mentioned that he was going to leave behind his urban lifestyle where he was living, and that's going to mean selling his house. And so a lot of retirees are beginning to do that. Vanguard did a study recently in which they then yielded the results, and it said generations of retirees have tapped into housing wealth as a source of funding for their retirement, and they're relocating to cheaper housing markets. Now, I don't think North Carolina is probably a cheaper housing market. That's probably going to be here in the Missouri Ozarks or maybe down in Arkansas or somewhere like that. But about 60% of retirees migrate somewhere else when they retire, and they're on average taking out about $100,000 of home equity that they're able to use and spend in retirement, and even more than that if their house is paid off. So there's some good ideas there. I'm not going to just frown on that one. I'm going to say this one could put Bob and Alice in the nice category, and we'll have to think about it a little bit more, but it's got some potential.
That is true. It is a very nice scenario for Bob and Alice there. I've got time for one more scenario. This is Julie and Bill. They've worked hard all their life and busily saving for retirement, and now they've got a chance to make it because their daughter Emma's ready to head off to college, and the tuition fees are high. They're pretty steep. They're torn between dipping into their retirement savings to help pay for Emma's education or letting her apply and take out some high-interest student loans. Ultimately, what they want to do is put themselves first and let Emma take charge and control of her own education. So Barry, as retirement Santa, it's their decision not to use their retirement savings to help Emma fall into the naughty or nice list to you.
Well, I'm going to give them a little bonus advice here first. Congratulations on Emma being ready to go to school. If I had one ready to go to school, one of the institutions that I would make sure that my child was exposed to is High Point University in High Point, North Carolina. I was there just this past week and spent a part of the day with the president of High Point. His name is Nito Quibin. And Nito is an interesting leader himself. So go to YouTube and look up High Point, North Carolina, High Point University, and just watch their videos. You'll find it's a lovely place. I'm a big fan of College of the Ozarks down at Branson. I'm a big fan of Liberty University out in Virginia, and I am now a new, bigger fan of High Point University. So I'd want Emma to see that. Now, here's the thing you got to know. It's going to cost $67,000 a year for Emma to go to High Point. They'll scholarship about a third of that. So it's in the 40s. So Emma's got a pretty steep thing. Should you pay for that or should Emma pay for that? And the answer to the question is, I think Emma should pay for the vast bulk of that. I want you to use other money besides your retirement to get Emma an education. Here's why. There are a lot of people who care whether or not kids get education, and they fund those kind of things. Nobody cares whether Julie and Bill retire except Julie and Bill. So Julie and Bill need to focus on what's most important to them. And I know Emma's important, but they need to focus on their retirement. And while loving Emma, and some other folks will step up and help Emma get the education she needs in a combination and variety of ways. So I'm going to give them a nice today just because they got Emma there. They're maybe going to take Emma to High Point. That'd be a good decision. And they're trying to make the right decision, and you get nice for that. So Santa's going to leave with nice boots today.
What you said is exactly right, Barry. That is the correct decision for them to make. Barry, we've reached the end of our hour. My goodness, holiday greetings to you, friend. I'm very thankful and blessed to be with you every Sunday right here on Talk 104. And any holiday greetings you want to send to our friends all around Springfield and the Ozarks?
Oh, my. There are so many of them, Ralph. You know, I always try at some point to just stop and remember what it's about. And it's not about candy canes and Christmas presents. It's about the fact that God so loved the world, he gave his only begotten Son, Jesus, as a baby in a manger, that whosoever would believe in him would not perish, but have everlasting life.
Also beautifully said. I am so grateful to be with you every week, Barry. We'll continue on into 2025 on radio and on all the Springfield TV stations. And friends, we'd love to have you join us every chance you get to get more of the wit and wisdom of J. Barry Watts. This is Ralph Hipp for Barry Watts and his whole amazing crew at the WealthCare Corporation. Thanks for joining us, and we'll see you again next time right here.
Thank you for stopping by Watts on Wealth. If you would like Barry and his team to help you make a plan to get to and through retirement, or would simply like a second opinion on your current plan, Give us a call today at 417-200-3500. That's 417-200-3500. And join us again next week for Watts on Wealth.
WealthCare Corporation provides tax strategy, tax compliance, accounting, and insurance services through its affiliate American Tax Strategies, LLC. Investment advisory services are provided by WealthCare Asset Management, LLC, an SEC-registered investment advisor. Investing involves risk, including the potential loss of principal. Past performance never guarantees future results. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for information and entertainment purposes only and should not be used as the basis for personal financial decisions without first consulting a qualified advisor. The information and opinions you've heard are believed reliable but cannot be guaranteed as to accuracy and completeness.